Welcome to Beavers Wealth Management's June 2024 edition of Let's Talk Markets. I guess I should say it's our July 4th edition. As you can tell from this tie, I'm ready to go next week. As you know, it's our goal to continue to grow Let's Talk Markets with the intent of educating and empowering the families and businesses we serve. So if you know of anyone who may find this information valuable, please feel free to share it with them. And I got to tell you, we've got a great show for everyone that's joined us today. As we typically do, this edition will focus on three key points. A quick glance to the past. What happened this past June in the markets? Secondly, a hard look to the present. A discussion on the state of the markets now that we're halfway through 2024. Can you believe that? And then third, a look to the future. Industry-level innovation that's actually happening in our own backyard. It's going to be a great show. So let's talk a little bit about what happened in June. I'm going to start with Ryan's Market Fact. And so his quote for this month is, "There is no impossible in the markets." 10 years ago, NVIDIA had a market cap of $10.9 billion. Since then, its market cap has increased 305 times to $3.33 trillion. This month, NVIDIA surpassed Apple and Microsoft to become the largest company in the world. A note, this actually marks the first time in history that the S&P 500 includes three $3 trillion companies. So a little even more on NVIDIA. If you joined NVIDIA 5 years ago as a mid-level manager, your annual $70,000 stock grant over the last 4 years, that initial grant, you ready for this, would be worth $10.6 million today. This month, NVIDIA topped the individual stock market values of Germany, France, and the UK. Now, I'm showing this graph here looking at the best performing S&P 500 companies over the last 30 years. NVIDIA, as you would expect, it's the best performing stock. But this chart, it shows you, and it kind of opens up a broader discussion on the best performing stocks over the last 30 years. Some of them you recognize, some of them you probably didn't even think of it. I was a little surprised that Monster Energy drink, that was in the top 5. Okay, in case you missed it, there's 4 things to think about from the month of July. First one, Apple's AI integration. So during its Worldwide Developers Conference, which they coined WWDC, Apple announced the launch of iOS 18, which includes Apple's official embracement of AI called Apple Intelligence. This personal intelligence system, it uses device content to provide personalized assistance. Additionally, Apple announced a partnership with Microsoft-backed OpenAI to integrate ChatGPT into iOS 18. This news actually pushed Apple's share to a record high in June. Now, it was with a bit of controversy, because if you saw, Elon Musk came out and said, if they're incorporating ChatGPT, I don't want any of my employees utilizing their phone for risk of privacy issues. It'll be interesting to see how this all plays out, but that's a big news that's come out of this past month. Second, Eli Lilly's Alzheimer's drug. This is important news across the board because it's an FDA advisory panel. They actually recommended the approval of Eli Lilly's Alzheimer's drug, donanemab. This recommendation, it's a significant milestone for Eli Lilly, and it potentially opens up a new market and provides a much-needed treatment option for Alzheimer's patients. Their stock price actually rose more than 2% in extended trading on the day of the announcement because the panel's endorsement increased the likelihood of the drug's approval actually happening later this year. Thirdly, Netflix. It's announced plans to open what they're calling a Netflix House entertainment venue at the Galleria here at the Dallas Mall. So this new concept, it aims to create immersive, year-round experiences based on popular Netflix shows, such as Stranger Things and Squid Games. The venue, it's going to include themed attractions, retail shops, and food and beverage offerings inspired by Netflix series and films. It's going to be the first of its kind. And so we're seeing a streaming giant try to tiptoe their way into entertainment parks. That's a market that a company that we've talked about dominates. Anybody heard of Disney? We're going to talk a little bit more about this in a bit, but it could be very interesting to see how the market interprets this for Netflix. And finally, I've got some bad news. Our fourth thing, Red Lobster, they filed for bankruptcy. They said they had more than $1 billion in debt, and they're going to close nearly 600 restaurants. I'm sad. I love those cheddar biscuits. They're so good. I actually remember the last time I was there, and I thought to myself, I go, man, I knew I shouldn't have had seafood. I'm feeling a little eel. Okay, state of the markets now that we're halfway through 2024. Well, as we reach the halfway mark of this year, which is just insane to me, it's great time to kind of step back and let's see how the markets have evolved over the past 6 months. 2024 has certainly been a year of exceeding expectations. Looking back to the beginning of the year, I mean, it would have been hard to predict the impressive heights the markets have reached by mid-year. And now, as we stand halfway through 2024, we find ourselves in a position of remarkable achievement and growth. And let's start with just a quick look at where the key indices stand today. So as of close of business today, Dow Jones Industrial Average over 39,000, and that's a 4.9% increase for the year. S&P 500 over 5,400, which is a 15.4% increase for the year. And the NASDAQ up 18% for the year. These numbers are staggering, right? But they set a stage for kind of a deeper dive into the various aspects of capital markets. So examining the performance of all aspects of the markets, it's going to help us understand not only where we are now, but also how we can strategically navigate the second half of the year. Okay, you want to talk some stocks? Let's do it. The 2022 bear market, man, I don't know about y'all, but it's kind of fading away from memory. So what's propelling the market higher? And really it's two main factors. First of all, higher earnings. The S&P 500 trailing 12-month operating earnings per share, it hit another high in Q1, up 8% over the past year. And I've always said this, it's going to be earnings are what are going to move markets. Higher earnings, higher markets. We've also seen higher multiples. Right? There's enthusiasm over the AI revolution. It's led to significant multiple expansion over the last year, with the S&P 500's PE ratio increasing 19%. Now, this is something that we need to watch out for because we've gone from a PE ratio on the S&P 500 of 20.5 to 24.3. This is actually the highest valuation that we've seen since June of 2021. Something that we obviously will pay very close attention to. Now, U.S. equities are once again outpacing the rest of the world. So this is a trend that has persisted now for well over a decade. But within the U.S. market, we're seeing a couple things. First of all, large cap stocks are outperforming small cap stocks. And this is actually the highest relative strength since June of 2000. Now, this, to me, is probably the most staggering of any of the stats out there. We've seen insane concentration within the S&P 500. The top 3 holdings in the S&P 500, and now we all know them, right? Microsoft, Nvidia, and Apple. They now make up over 27% of the index. 3 stocks, 27% of the index. That's the highest percentage on record, and that data goes all the way back to 1980. Now, we've also seen massive outperformance from semiconductors, which makes sense because of the AI revolution that we keep talking about. And of course, growth stocks, they're continuing to outpace value-based stocks. The ratio of growth to value is nearing its highest level since 2000. The other thing that we also need to watch out for, we're continuing to see weakness in regional banks. Now, more specifically, let's talk about the S&P 500, right? So here's some interesting stats on that index. The S&P 500 is now above every 2024 year-end price target from Wall Street strategists, which you can see here on the graph. And there's still 6.5 months to go. So we're halfway through the year, and we've met every analyst expectation already for the end of the year. The S&P 500 is now over 25% higher than where it was when the Fed started hiking rates in March of 2022. I don't know if you remember, but you turned on the TV and it seemed like when the Fed started hiking rates, they said the end was near. The markets were going to pull back significantly. Well, we're up 25% from when they said that in 2022. Another interesting stat, the S&P 500 has already hit 31 all-time highs this year. So basically, you get an all-time high, and you get an all-time high. Everybody gets an all-time high. They're averaging more than one a week thus far in 2024. So every week is a celebration, right? The S&P 500 also crossed above 5,400 for the first time, and that's the 6th 100-point milestone of the year. This is maybe the most interesting, the 15% gain for the S&P 500 in the first half of 2024. That's the best start to a presidential election year ever. Okay, that's a little bit about stocks, but what about bonds? Well, the U.S. bond market, it's in a very different place than the stock market. While the S&P 500 has been hitting all-time highs this year, the Bloomberg Aggregate Bond Index, it still remains almost 10% below its peak from the summer of 2020. At 46 months and counting, this is by far the longest bond bear market in history. Now, the story behind the long drawdown, I mean, it's simple, right? Rising interest rates from 2020's historic lows. Now, the U.S. yield curve, it's defined as the 10-year yield minus the 3-month yield, and it remains inverted. It's extended, which has already become the longest inversion in history, almost 600 days. Once again, you remember when you turned it on the TV and they said, oh my God, the yield curve is inverted, the end is near, the recession is coming. That was 600 days ago. So keep that in mind the next time you turn on the TV and you hear somebody telling you the end is near. All right, what about the economy and the Fed? Well, the U.S. economy, it continues to grow. Now, I bet it's at a slower pace, right? The 1.3% annualized growth rate in Q1 2024, that was notably lower than the 3.4% registered in Q4 of 2023. Now, that's to be expected, right? Q4 typically is a better time for the economy with all of the holidays and everything else that happens in retail. But the key point and the key takeaway is that we're in an expansion. Right now at 48 months, this expansion, it can continue. The last 4 expansions lasted a minimum of 73 months. And we're 48 months in. Also, GDP growth expected to continue for at least another quarter. Analyst forecasts are about 2 to 3% for real GDP growth in Q2. Now, inflation, it's persistently high, right? We know the CPI, it's still above 3%, and that's now 37 consecutive months of persistently high CPI, above 3%. That's actually the longest stretch since the late 1980s and the early 1990s. So even though we've been talking about inflation slowing, what we're really saying is the rate at which things are increasing are slowing. But don't get us wrong, things are continuing to increase and get more expensive. So when you feel like prices just aren't coming down, that's because you're right. Prices aren't coming down. They're just increasing at a slower rate than what they have been. And what about consumer spending? Because we know consumer spending is what drives the markets. Retail sales, they actually fell 0.7% over the past year after adjusting for inflation. We need to watch out for that as we know the consumer drives these markets. Labor market, it remains strong with a 3.9% unemployment rate. but job openings, they've actually decreased significantly from their peak. So wage growth has outpaced inflation over the past year, and that's a really positive sign for the American worker. But what's the Fed's message? The Fed said, we need greater confidence. The Fed held rates steady at 5.25%, 5.5% this past month. And they stated they needed greater confidence that inflation is moving sustainably toward 2% before they cut. Now, the market is currently saying by September, with a greater than 70% probability of a rate cut priced in for that month. Now, as you can see here from the graph, the Fed lifted their median year-end forecast for the Fed funds rate to 5.1% from 4.6% previously, indicating just one rate cut in 2024. What's funny to me is that we started this year and the average analyst prediction was 6 rate cuts. Now we've gone from 6 to 4 to 2 to now 1. We know projections for 2025 and now 2026 point to a slower move lower with 100 basis point cuts in both years. So let's just assume the Fed's preferred measure of inflation, the core PCE, which we've talked about, moves down to 2.3% in 2025 and then in 2% in 2026. We actually believe monetary policy is going to remain restrictive for another 2.5 years. So what is Beavers Wealth Management's belief on all this? Because I know we've covered a lot here. How do we take all this information and then apply it to the coming months of 2024 and beyond? With an election around the corner in November, we can expect increased levels of uncertainty in the market. However, the performance this year, it's actually shown us that markets are incredibly resilient in the face of uncertainty. We've navigated through many challenges over the past few years, and yet the markets, especially with AI leading the charge, they've proven their strength, right? The key takeaways from Beavers Wealth Management is that navigating these waters successfully means being in the right places with the right strategies. And it's not about timing the market, which we all know is nearly impossible over a consistent period of time. Instead, it's about having exposure to the areas of the market that are poised for growth and feeling confident in your investment strategies. So amidst all of the noise, having a robust plan that can weather any storm, that's what's crucial. So if you know of anyone that could benefit from just a second set of eyes on their investments, we'd love to help. Ensuring that you're confident with your investments is our top priority, and we're here to support you and those that are important to you every step of the way. Okay, now let's talk about something interesting that's coming in the future, and let's talk about the Netflix house. So last year on Let's Talk Markets, we actually talked a little bit about the Texoplex and some of the amazing new innovations and growth that we're actually seeing here in our home state of Texas. And we always keep our eyes open and ears peeled for any interesting developments in our backyard. And today we wanted to highlight something very exciting, not just from an entertainment perspective, but also from a market perspective. So as we all know, real estate has been one of the worst performing sectors this year, and it's faced many challenges in a post-COVID environment. And we've seen a lot of vacancies in malls and office buildings. So finding new uses for that space, something that we have to consider, right? And we wanted to highlight Netflix's plans to open up Netflix House right here in Texas. So Netflix plans to open this Netflix House in a bold move into the entertainment space. So it's gonna be similar to Disney's theme parks, and it's opening at the Galleria in 2025. This marks Netflix's first venture into physical entertainment spaces, offering fans a chance to engage with their favorite shows and characters in a whole new way. So the Netflix House at the Dallas Mall, it'll take up over 100,000 square feet, making it a major draw for foot traffic, and it's going to really revitalize that area. The thing I like about it, it's an experience that's going to be food-based, vibrant, and ever-rotating, so featuring sets and experiences from popular Netflix shows like Bridgerton or even Squid Games. Netflix entering this market is noteworthy, and it represents a new trend for streaming giants diversifying their engagement strategies. So let's kind of dive in a little deeper into this, right? This initiative is not only it provides entertainment, but also serves as a potential model for addressing some real estate challenges that we currently have. Because post-COVID, I mean, we know this, there's been a significant increase in vacancies in malls and office buildings. We see it. Real estate has struggled, and being innovative and using these vacant spaces, it's crucial. This approach to using the vacant real estate space could inspire other businesses to think creatively about how to repurpose these areas. And that's positive for markets and this continued growth that we see. Netflix's bold move into physical entertainment spaces with Netflix House is something to keep an eye on. The fact that it's opening in our own backyard here in Dallas is exciting for us. It's a creative solution to the current real estate market challenges, and really it's an exciting development that's happening right here in Texas. I don't know about y'all, but I can't wait to see it come to life and explore what it has to offer. Okay, so in conclusion, what did we cover today? First, we recapped the past month of June, examining what's been happening in the markets. Second, we took a step back and we addressed the state of the markets now that we're halfway through 2024. And finally, we looked at something kind of cool. We looked to the future and we discussed a unique way that Netflix is trying to take advantage of a struggling commercial real estate market. We truly appreciate you joining us today, and we are grateful for each and every one of you. If you enjoyed today's content, we'll have the replays of Let's Talk Markets posted on our new YouTube page. Check it out. And the video podcast format is actually going to be on Spotify. So please share with anyone you know who may find this valuable. Thank you so much for tuning in. I know it's hot out there, and I don't know about y'all, but the best way to beat the summer heat, I think, is cooling off with some ice cream. Speaking of which, did you know where you can learn to make the best ice cream? Sunday school. Stay cool, and see you in July for our next installment of Let's Talk Markets. Oh, and don't forget, leave it to Beavers.